Joining us right now is Sri Iyer, Managing Director and Head of Systematic Strategies at Guardian Capital. Sri, it's really a pleasure to have a chance to talk to you today.
Thank you, my pleasure.
Thank you so much. Now, Sri, you were just up on stage. You were addressing advisors at the Set from Mind Path conference. Yield is really scarce. It's really become a difficult thing to garner from investment portfolios. In particular, your area of management is systematic strategies using, and today you spoke about artificial intelligence and using artificial intelligence and big data to find yield.
I think today AI has become very popular. It goes across every part of society right now, and investment management industry is no different. The objective of using AI is basically to solve a problem. And the problem we are trying to solve is, can you create sustainable yield for the long term? A lot of people chase yield because they're looking at it as a near-term venture. For us at Guardian Capital, income and yield is a long duration play. Now, for predicting long duration sustainable yield, you need a process that covers the growth, the payout, and the sustainability of yield over the longer term. The emergence of big data over the last recent years, in fact, if you wouldn't believe it, 90% of all data in the world has been created in the last 2 years. 90%.
That's insane.
It's a phenomenal number. It's all digital data. It's your Twitter, it's your media, and all that digital data.
Right.
The question here becomes that if I, as a money manager, am simply using price to book and price to earnings to pick stocks, that information is completely arbitraged out in the market space, while all this new digital information has got a wealth of knowledge. So big data and data science has evolved to capture that data and create knowledgeable information that we can use to our advantage. In our case, we're using it to pick dividend companies that will grow their dividends. So the objective of artificial intelligence and machine learning is to train machines and models with past data, both traditional data sets like profit and loss, balance sheet, cash flow data, just like every other fundamental manager we use it to, but also alternative data like news sentiment and specific data like credit card transactions and other types of data sets that we can use to train a machine to predict whether General Electric will cut its dividend, or even a Warren Buffett stock like Kraft Heinz will cut its dividend. So the true purpose of this is to solve a problem, which is sustainable and growing dividends.
Now you're not just trying to solve this problem for retail investors. You're trying to solve this on a much larger scale for large-scale investors, pension
as well
funds,
as every
institutional.
Other individuals, correct.
And have you cracked this nut?
Well, we feel that the opportunity set here is, with an aging population, there'll be about 1.5 billion people that are aging simultaneously across the world. And so the 60-plus population is growing. Now, the 60-plus population is not just looking for income on their personal side, but they're also employees of big corporations and pension plans and everything else.
Right.
So the liability mismatch of aging workers and pensions supporting them beyond aging from 65 to 85 or 100 is getting longer and longer. So the need for income is pervasive across both institutional asset space as well as the retail asset space. So the way we are tackling this problem is trying to go up the duration curve and going further out on the duration, so that looking out 10-year, 12-year, 15-year, 18 years on the sustainability of cash flow cycle, rather than just looking at the 1 year, 2 year, 3 year, and just looking at a high dividend yield and paying it off to somebody. So the way to crack this nut is to look further out.
Right.
And look at things that others are not looking at. And
well,
that's where we feel
it's an interesting, it's fascinating because you keep hearing about how many pensions are underfunded globally, in the U.S., domestically, because of financial events of the last 10, 15 years, and because of demands, because of demographics. So It's fascinating. Is this a constant work in progress?
I think AI is a constant work in progress. We have barely scratched the surface.
It's new.
It's very new.
Yeah.
It's very new. And the failure rate is about 90%. So you fail more than you succeed. So when you do come up with some discovery or you do come up with a process or methodology that allows you to predict with a higher degree of accuracy, it becomes very, very important. I do want to emphasize that the objective of using machine learning and AI is to improve the accuracy of a prediction. As a money manager, I'm predicting a company's dividend growth, and I'm predicting a company's dividend yield and make sure that it doesn't get cut. These are predictions.
Absolutely.
Artificial intelligence allows me to make those predictions with a higher degree of certainty and accuracy than I normally would if I just read research or read the newspaper or read just balance sheets and profit and loss.
So it's an extension of your capabilities.
It's an extension of our capabilities.
It's not. I mean, like the AI part of what you're doing is not your full-time work. It's ongoing.
It's ongoing.
But your full-time work is actually
yes,
as a PM.
It is HI plus AI.
Yeah.
It's human intelligence plus artificial intelligence. Our industry tries to make them mutually exclusive.
Right.
You're either AI or you're a fundamental PM. That's not true.
Yeah.
You could be a fundamental PM and have AI. You could be a human portfolio manager and have AI assisting you to do your job well. And that's where this market is changing right now, and we are the forefront leaders when it comes to dividend investing in that.
Right. So you're taking your methodologies and teaching them to a machine, to the computers.
You said it dead on.
Okay. So is this is something that you see as expanding further?
I see we have a big incumbent advantage right now because we have proprietary knowledge. I have a team of data scientists, so whether they're industrial engineers, statisticians, mathematicians, computer scientists. So it's a team of data scientists who are now scrounging the world for alternative data sets and trying to figure out what types of data sets will do a better job in predicting either dividend growth or a dividend cut. And now we expanded even further out in predicting earnings growth and earnings cuts. So it's an ever-expanding phase in the evolution of R&D and research and development in the world of data science. I feel it's a very exciting time for guys like us who have been in the what we call Gaussian Bayesian world, where everything is normally distributed.
Right.
In our world, but in real world, nothing is normally distributed. So now with artificial intelligence, you can actually fit the real world into real world problem solving. And AI has done a pretty darn good job so far in that space.
And are you optimistic that, since it's a work in progress, are you optimistic that you'll be able to find the way to a long-term sustainable dividend yield?
I'm optimistic that I will be significantly better at it than I have been in my 25 years of doing this.
It's fascinating because I think earlier we were talking about how technology has enabled all of the new strategies that are coming out in the ETF world, such as, for example, smart beta, where you can implement a set of rules to screen for a portfolio. But none of these things would have been possible to run consistently day in, day out for years without the technology that's come to the market. So, but in that respect, you're using much more of that technology.
Significantly much more.
Fascinating. Sri, thank you so much for your time. It's a pleasure to talk to you.
Thank you so much.